In this video, I'm going to talk about constant growth dividend valuation. So in this case, we have a stock that is paying dividends, and the dividends are growing at a constant rate of growth. So in a prior video, I talked about finding the value of a stock that pays dividends. And basically what I indicated was we need to find the present value of each of the subsequent dividends, and we'd add them all up. And that would be how we'd find the expected price or value of the stock. So what I've done here is I've actually depicted that. So I would find D1, my dividend at the end of the first year, divided by 1 plus RS to the 1. This gives me the present value of D1. Next term, D2 over 1 plus RS to the 2, present value of D2. D3 over 1 plus RS to the 3, present value of D3. The RS that I have here is the required rate of return for shareholders. So I'm finding the present value of each dividend. And I would just keep going. I would just keep going until I just got infinitely far out into the future for the dividends. I find the present value of each dividend, add it all up. This would be my expected price or value of the stock. Now, I'm going to kind of make things look worse before I make things look better. So let's kind of substitute. So if I have a stock that has a constant rate of growth, what we could do is if I know what the dividend was yesterday, then I should be able to find the dividend at the end of this next year, basically by applying that rate of growth. So D0 is going to be the dividend that we're going to assume that the company paid yesterday, which we know that, right? We know what they paid yesterday because it was yesterday. So we can look that up. So if I know what they paid yesterday and I know that there's a constant rate of growth, then what I can do is I can take D0, what they paid yesterday, times 1 plus the rate of growth, to push it forward to what they expect to pay next year, and that's going to give me D1. But by that same logic, if I know that D1 is going to be what that growth or dividend is going to be, I would need to have another year's worth of growth to get D2. Well, if that's the case, I would take D1 times 1 plus the growth rate to get to D2. Well, we know that D1 is D0 times 1 plus the growth rate. So in order to get to D2, I would take D0 times 1 plus the growth rate to get to D1 times another 1 plus the growth rate to get to D2, which means I'm going to take D0 times 1 plus the growth rate squared. So basically, if I use those substitutions for D1, D2, D3, and so forth, I'm going to substitute that into this equation that I had up at the top here. And what I get is this, D0 times 1 plus G to the 1 over 1 plus RS to the 1. D0 times 1 plus G squared over 1 plus RS squared. D0 times 1 plus G to the third over 1 plus RS to the third, and so on and so forth. Now, if we step back and kind of look at this, as long as that RS, the required rate of return, is larger than G, I've got this 1 plus G to the 1 over 1 plus RS to the 1. 1 plus G squared over 1 plus RS squared. 1 plus G to the third over 1 plus RS to the third. So as long as RS is bigger than G, the denominators of each of these successive terms will be growing faster than the numerators, which means each successive term gets progressively smaller. And if each term gets successively smaller, then in the limit, as basically the number of periods goes to infinity, there's actually an equation that we can collapse all this down and simplify it drastically, okay? And that's what I have on this next slide. Basically, I can collapse that whole infinite series of dividends down into D1 over RS minus G. And keep in mind, remember, D1 would be the same as D0 times 1 plus G. So if you have D0, you can take D0 times 1 plus G to get D1 to put it into the formula. But ultimately, this formula would take this infinite series of dividends for all eternity and find the present value of it. Which, I don't know about you, but that's pretty good because this is much simpler than that whole infinite series of dividends. So basically, all I have to do is take my expected dividend for the next period, divide by the required rate of return minus the growth rate that we're expecting, and there we go. I got the value of the stock if we have a constant growth in the dividend. All right. So this is representing the present value of an infinite stream of constantly growing dividends at a very specific rate. Now, an important little note here, most of the value that you're going to see, if you start thinking about all those separate terms, if you broke it all out into separate terms and looked at the magnitudes of those separate terms, most of the value that winds up in this final value or price estimate is coming from the first couple decades. Now, the reason why I'm emphasizing that is that's not necessarily a great feature because if you think about it, how much do we really know about the prospects of a firm decades from now, right? So that's actually a little bit of a downside for this. that actually is sensitive to what we think is happening, maybe 10, 20 years from now. So that's not necessarily great. Now, it is worth noting that if this model works, that's a big if, but if the model works, it's possible to find the future price at any point in time. All we have to do is just find the applicable dividend 1 year beyond that point. So if I want to know what the price would be at the end of year 10, all I need to do is find the dividend that I would expect for year 11, because that'd be 1 year further out. And then that would be my D1 over RS minus G, and bingo, now I've got the value at the end of year 10. So the kind of nice thing with this model is I can figure out the price at any point in time if this model is working. Now, a few little notes. What happens if the expected dividends change? Well, if I look at this model, if I increase the expected dividend, then the price would go up, which makes sense. If we expect the company to be more profitable, to pay out more to shareholders, we expect the stock to be more valuable, makes sense. But that also means if the dividend that we are expecting declines compared to what we expected, then that would actually mean that the price or value would go down. So for instance, if a company unexpectedly cuts the dividend, the stock price is pretty much going to drop. How about the required rate of return? Well, if shareholders require a higher rate of return, they would increase the RS value. Maybe we go through a recession, people are concerned about how stable things are, they think things are more risky, they therefore require a higher rate of return. Well, if I put a bigger RS value here in the denominator, this is going to make the expected price smaller, or expected value smaller. So if people are more pessimistic and they require a higher return, value gets smaller. And so that would be consistent with the stock price going down if people are more concerned about the risk. On the other hand, what if the growth rate gets larger? Well, if the growth rate gets larger, then I have a bigger number here that I'm subtracting, which is going to make the denominator smaller. And if I take the same number divided by a smaller denominator, then my expected price is going to get larger. So if I have a more growth expectation than I used to, then the price would go up because we are essentially valuing all of that growth. Now, you should also kind of think through what would happen if these things decreased, right? So if the dividend went down, price would go down. If the required rate of return went down, people think it's less risky, price actually goes up. If the growth that we're expecting goes down, then in that case, the price would go down, okay? So something to kind of think about. Now, this model is not perfect. There are all kinds of limitations. I'll talk about other models in subsequent videos, but it does have some good intuition, and it makes you kind of see what happens with expected changes in dividends, changes in required rates of return, changes in growth rates, and it kind of shows you this is what we would expect to occur. And that can be kind of a helpful thing to start with. Hopefully this video has been helpful. Thank you so much for watching, and have a great day.